All right, hard landing, soft landing, recession, any way you slice it and whatever you call it, global growth is expected to slow this year. From the OECD, we're seeing the World Bank and now the IMF saying the doom and gloom is far and wide. The International Monetary Fund has trimmed its growth forecast for this year, and even though it predicts inflation will come down, it's still elevated. To discuss the IMF's World Economic Outlook, let's get to Yahoo Finance's Jennifer Schonberger. Hey, Jennifer.
Thanks, Rochelle. I want to welcome back to the program Chief Economist of the IMF, Pierre-Olivier Gourinchas. Sir, welcome back. It's great to see you.
It's great to see you, Jennifer.
So to kick off the conversation, how have the recent bank failures in both the U.S. and Europe impacted your outlook for growth? What is the risk that the global economy is teetering on the edge of recession?
Well, it's impacting us in forecasting in a number of ways. I mean, first, we have our baseline forecast, which predicts that growth will be low at 2.8% and then will be gradually increasing. And that forecast already takes into account that there might be some tightening of financial conditions, some contraction in lending in some economies. Then we do a separate calculation where we say, well, what if the contraction in lending turns out to be more severe? And we run our models, and then we come out and we say, well, that's still a fairly likely scenario, but now growth would only be about 2.5%. That's still a situation where financial instability is contained. We don't have a financial crisis. Then there's a third scenario, that's sort of like the gloomiest scenario, where we say, well, what if that cannot be contained? We have a full-blown financial crisis. We have capital flowing back from emerging economies to the U.S. treasuries. We have the dollar appreciating. We have all kinds of risk assets collapsing. And then we have the growth for the global economy would plummet to about 1% this year. Now, that's, of course, an extreme scenario. We estimate the probability of such a low growth rate is about 15%. So it's still relatively low, but we wanted to sort of cover the range of outcomes that are possible here.
Pierre, how would you characterize global stability right now? Do you think that these bank failures are isolated or they are a harbinger of more challenges, tighter credit conditions to come? Is there contagion risk here?
Well, certainly the markets have been quite nervous in the last few weeks, and the financial sector has been severely tested by the increase in interest rates we've had in the last year, and that has generated losses for banks' balance sheets and non-banks as well, as we saw last fall, and also increased funding costs for banks as they're now, depositors are looking at how much they're earning on their deposit account, their savings account, and they're asking maybe, well, we should get a little bit more. And so that is a concern going forward. Now, the good news is that the banking sector in particular is in much better health overall now than it was at the time, say, of the global financial crisis. There's a lot more capital. The banks are better regulated. There are all kinds of liquidity requirements, et cetera, especially for large banks. And so overall, the health of the banking sector is much stronger. But it doesn't mean that there couldn't be pockets of illiquidity, pockets of vulnerabilities, and financial authorities need to be quite careful and monitor this because things could spread pretty quickly.
Yeah, well, to your point, how should central banks sort of walk this tightrope between managing inflation risk and the potential for credit tightening or liquidity issues? Do you think they should take a step back like the Bank of Australia did, sort of pause and see, or continue on their way?
At this point, we don't think they should take a step back. I mean, first, let's realize that most advanced economies' central bank may already be near the peak of their hiking cycle. So a lot has already been done, and then we should see the effect of that in the coming month and in the rest of the year. So there isn't really any indication that central banks would need to hike massively from where they are right now. Of course, there's always a risk that inflation might be a bit more persistent, but even then, I don't think anyone is anticipating a very, very sharp increase in policy rates. But having said that, the second factor to take into account is this financial fragility is going to lead probably the banks to be a little bit more cautious in extended lending. And so they are going to contract lending going forward. How much is still to be determined. We don't know quite yet. But that's also going to weigh down on activity. That's going to cool off the economy, bring down inflation. And what that means is that central banks don't need to do as much because the lending sector is going to be doing some of it for them. But what's really important at this point is that central banks should not veer away from the fight against inflation, for financial stability reasons. We don't think that would be appropriate. There are other tools that are available to financial authorities that need to address localized pockets of vulnerability, and that doesn't require adjusting the policy rates or giving up on the fight against inflation.
Pierre, you see inflation coming down this year, headline inflation, I should say, to 7% from 8.7% last year. As you estimate, oil prices are expected to drop by 24%. I'm curious how you're factoring into that OPEC's recent oil cuts announcement. What makes you think that we're going to see oil prices come down that much and the impact that we could see on inflation? Is demand going to cool that much?
Well, so first, the recent announcement by OPEC that they were planning to cut production for the rest of the year, I should be clear that this came after we'd already closed our round of projections. So this is not, that announcement is not reflected in our projections. And what we can see is, OPEC is announcing that they're cutting production by roughly 1% of world production. And we've seen the price of oil going up by about 8% in the days following that announcement. So certainly this is increasing the price of energy. This is going to feed into, the consumer price index. This is certainly not going to help inflation coming down. I mean, we see this effect as relatively modest right now, but certainly going in the direction of making inflation more persistent and requiring more action on the side of central banks going forward.
Pierre, you're there on the ground at HQ for IMF World Bank spring meetings. What are you hearing? What is the topic of discussion? Is it the bank failures? Is it inflation? What is top of mind?
Well, there are a number of topics that you can imagine. We have a gathering of most authorities from our membership here during the World Bank and IMF spring meetings. Obviously, questions around financial stability, questions about risks to the banking system and the non-banks, that's certainly top of mind. Lots of discussions about how to deal with the debt crisis for many highly indebted countries that are in situations of debt distress. That's something that certainly has been a concern for some time now, and the fund is certainly hoping, in conjunction with its partners, to make progress on this front. And then there are broader topics like climate change and how to engage in this and how to mobilize multilateral development banks and the role of the IMF in that context. So lots of big questions that we're tackling this week at the IMF World Bank spring meetings.
Well, we'll be watching closely, Pierre. Thank you so much for your insight. I so appreciate it. Hope to speak with you again soon.
You're welcome. Thank you, Jennifer.